Welcome back. Today, we are looking at an investment analysis report that argues for a strong buy rating on LUNR Stock. That's Intuitive Machines.
Right. And the core idea is a potential 54% upside, driven by some big catalysts in 2026.
Exactly. The report's thesis is that the company is moving from a proof of concept startup to being a really reliable government contractor. So let's dive right in.
I agree. The research here is solid, no question. It's well executed. But I think for the kind of audience this is aimed at, a sophisticated, high-level audience, the presentation needs to match that rigor.
I see that. It makes a very aggressive case for a $15 price target, and it uses the successful IM2 mission as, a key data point.
It does. And the stated tone is energetic, informative, objective, but optimistic.
Which brings us right to our first point of focus.
Yeah, because I have to wonder if aiming for that deep institutional credibility, it might demand a pretty significant refinement of that tone. We have to be clear. Is the audience retail traders or professional capital allocators?
Well, the argument in the material itself is that the company is transitioning, that it's becoming this mature, reliable government player.
Right.
So if that's the thesis, the tone of the analysis really needs to reflect that seriousness.
Exactly. I think to maximize the impact on sophisticated investors, the analysis report should replace the retail investor hype vocabulary with professional institutional language. It has to match the company's claimed transition to a reliable government contractor.
Okay.
The challenge here, what we're seeing, is the persistent use of market buzzwords. Things like LUNR Stock to the moon.
Right, with the emoji.
And stressing the massive 54% upside, describing the investment as just a volatile ride. All of that, it really detracts from the analytical rigor that's been established elsewhere.
That tension is so clear. When the whole point is about moving towards stable, multi-decade government contracts, using that high-energy, almost social media tone, it just undermines the argument for maturity right away.
It does. It's like you're telling the investor, trust us, they're stable now, but you're shouting it through a megaphone.
Yeah.
And that tone, look, it's effective for grabbing attention, but it fundamentally weakens the central thesis that this company is ready for long-term government work. So the suggestion is really to shift the stylistic foundation, prioritize objective financial assessment, and, risk management terminology.
Okay, so anchor the confidence in contract metrics instead of just the percentage gains.
Precisely. Anchor it in proven operational validation.
But doesn't removing all that excitement make the report sound a little dry? How do we maintain the energy while using terms like terminal value analysis or execution risk?
The hook becomes the intellectual rigor itself. That's the exciting part for this audience, not just the raw percentage gain. So for some concrete examples, instead of opening with a visual of the stock chart rocketing up,
Which is very retail-focused.
Instead, start the hook by defining the company's competitive moat. Focus on their proven operational track record at the lunar South Pole. That is a huge barrier to entry for anyone else. That's the real story.
Okay, so the substance is the hook.
I take and replace it with a formal, structured articulation of the risk-reward ratio. Base it on execution probability. You can use terms like execution risk, liquidity concerns, or frame the valuation using terminal value analysis. Doing that just immediately elevates the rigor of the entire piece.
That's a powerful shift. It really forces the language to support the thesis. So if we're moving toward an institutional tone, we have to make sure the financial foundation, that it matches that rigor as well.
Absolutely. Financial completeness is critical.
So let's pivot to that. The material does a good job on revenue scaling. It notes a solid TTM revenue of $220 million. But it's also very frank about the operating loss, which is significant, at a negative 193M TTM.
And the argument is that the market is just forgiving the losses.
Right, because of this huge NASA contract pipeline.
Which, conceptually, that makes sense, especially in a high-growth sector like this. But for this audience, that statement requires a lot more due diligence on the timeline. I think the analysis has to more rigorously address that large valuation gap. It needs a detailed roadmap from the current net loss to projected profitability.
So you're saying it has to specifically tie future high-margin revenue to a cash flow timeline?
Yes.
Okay, because the justification for the high valuation is future infrastructure value, right? The LTV program, the Near Space Network, these things that are supposed to become cash cows.
But just saying the market is forgiving the current cash burn, that's just not sufficient.
No.
That is the exact leap of faith an expert audience will not take without verification. The weakness here is that while the report presents the negative net income accurately, it dismisses this crucial metric too quickly. For a professional, it leaves a huge question unanswered. How exactly does this infrastructure become a cash cow by 2026 or 2027?
And what's the required CapEx, the capital expenditure, needed to get to that point?
Yes. And even more critically, with that $193 million TTM loss, there's a fundamental question of survival, right? Of just getting through that transition.
The lack of any discussion on potential future dilution or capital raises is a major gap, especially with that cash burn rate.
It really is. If we assume that burn rate continues, an investor has to know the projected cash runway. They need to know the probability of a secondary offering. So the suggestion is to bolster the financial health check section, integrate a forward-looking financial model that actually justifies the high valuation.
So it's about articulating when that inflection point of positive free cash flow is expected.
And supporting it with explicit contract milestones and operational metrics.
That level of detail, it transforms the analysis from just market observation into a robust, justifiable financial projection. So what would that look like in practice?
Okay, for concrete examples, you could provide a hypothetical breakdown, show the required R&D for the LTV design phase versus the projected high-margin revenue from the NNS data services.
That would justify the CapEx.
It would. And furthermore, you need to quantify how much of that $220 million in revenue is recurring, how much is project-based, or how much is high margin. Those distinctions define the future quality of cash flow.
Right.
And most importantly, discussing the firm's required cash runway and the associated dilution risk if, say, the IM3 mission faces more delays, that would significantly strengthen the risk assessment. That kind of transparency is the hallmark of institutional reporting. It would lend genuine credence to the $15 price target.
That is essential. Okay, so we've established the need for a more mature tone and a more rigorous financial roadmap. Let's now look at how the report presents the growth story itself. Specifically, the three major catalysts identified for 2026.
Right, the catalyst section. The report correctly identifies three key drivers for 2026. You have the IM3 mission, the Lunar Terrain Vehicle, the LTV contract, which is a massive $4.6 billion opportunity,
Huge.
and the Near Space Network data services.
And all three are obviously major opportunities. The LTV contract alone could guarantee revenue for years, but just listing them as three equally weighted massive catalysts, that feels, structurally misleading when you think about long-term value creation.
That is the structural opportunity we need to seize here. The core catalyst should be restructured and weighted. You have to distinguish between the mandatory short-term validation events and the long-term structural revenue drivers that truly justify that plus 44% upside.
So the challenge is that listing IM3, LTV, and NSNS as equals obscures how different they are.
Their differential impact, yes. It obscures their impact on the valuation thesis.
Can you explain that differential impact a bit more? Are they just fundamentally different kinds of events?
They absolutely are. IM3 is a critical binary. It's an operational hurdle. It's a pass-fail risk.
Okay.
If they succeed, it de-risks their existing technology. But if they fail, the entire government contractor thesis is threatened.
Right.
Conversely, the LTV contract and the NSS data services, they represent the multi-decade revenue infrastructure. That's what underpins the high price target.
So treating them as three equal milestones just muddies the water?
It completely muddies the investment thesis because they address totally different points on the risk spectrum.
So IM3 is less about growth and more about validation of the operating model. It's about unlocking access to those higher value infrastructure contracts.
Exactly. Sophisticated investors are not buying the stock for the one-off revenue of a single IM mission. They're buying the long-term structural revenue guaranteed by massive contracts.
Okay.
So the suggestion is to reorganize the structure, prioritize the valuation-defining long-term contracts, frame the LTV contract and NSNS as the reason for the $15 price target, and frame IM3 as the prerequisite de-risking event.
That brings a lot of clarity to the investment narrative. It aligns the weight of the discussion with the weight of the financial opportunity. So what are some concrete ways to implement that shift, structurally or visually?
Well, for concrete examples, you could dedicate a distinct major section just to the LTV contract. Focus heavily on quantifying the long-term guaranteed revenue stream from that potential $4.6 billion pie. That's the cornerstone of the whole thesis.
So you could, for instance, estimate the annual revenue commitment if LUNR actually secures the contract?
And compare that figure to the revenue from just one successful IM mission. The comparison immediately highlights the transformative scale. It's a night and day difference. Then, in a preceding section, you frame the IM3 mission specifically as the necessary step to validate their recurring business model and unlock those bigger contracts, rather than just presenting it as an end in itself.
So that structural change really gives LTV and NSNS the prominence they deserve as the ultimate drivers of the valuation.
It does.
That was an extremely focused dive into how to professionalize what is already a strong analysis report. Let's just briefly summarize the actionable steps.
Okay, so we highlighted 3 major opportunities. First, refine the tone. Replace that high-energy retail vocabulary with institutional language. Focus the discussion on things like execution risk, competitive moats, and a structured risk assessment. That supports the thesis of corporate maturity.
Second, the financial justification needs to be much more rigorous. So, mapping out that path from current negative income to positive free cash flow, including a clear assessment of future capital needs and dilution risk. That's essential to justify the valuation.
And finally, restructuring the catalysts. You have to properly weigh that short-term operational hurdle of IM3 against the long-term structural value drivers like the LTV contract and the near space network. You have to make sure the biggest revenue drivers get the most attention.
Absolutely. By replacing the high-energy language with rigorous financial and structural analysis, this report will be significantly strengthened. It'll transform from what is, effective market hype into a robust investment thesis that fully supports the company's claimed transition.
It really does have a very strong foundation.
It does.